We are starting with the next topics of chapter number 19, which will complete objectives of accounting, advantages of accounting, limitations of accounting, and classification of accounts. Now, objectives of accounting. The first thing is maintaining records. I have explained this to you earlier, but let me just repeat it one more time. This involves in identifying transactions that are of financial in nature only and that can be measured in terms of money. So what we do is that in accounting, we record only those transactions which are financial in nature and can be measured in terms of money and record them in a systematic, orderly fashion. That is why accountancy is an art. The second one is that calculation of profit and loss account. Now, why do we need to calculate? Why is this an objective? Because it is only to derive, it is only to ascertain whether the business or the company which one has started has earned a profit or it has incurred a loss. This is why we prepare a profit and loss account. Each company has their own rules. Profit and loss can be drawn monthly also. It can be drawn quarterly, half yearly or yearly. Generally it is done yearly, but depends on a company that if they want to see quarterly results, they will record a quarterly statement. They will prepare a quarterly trial balance. They will prepare a quarterly profit and loss account. They will prepare a quarterly trading account and a balance sheet. Whatever they want to do. So this can be done in whatever period or predetermined period of time, but it is to calculate profit and loss. This is the next objective. Now this is an example of a ledger. Now, as I told you, that journal means it records each and every entry. Each and every entry. For example, you have bought milk, you have bought bread, you have paid for furniture, you have paid for electricity, you have paid for newspaper, you have paid for stationery. Any and everything a journal will record. But a ledger will segregate that in groups. All the cash dealings will go into cash account. All the things which are purchased by the company will go into purchase account. Similarly, this is an example of a cash account. Now it shows that there are two sides to it, a ledger. It has a left side, which is the debit side, and it has a right side, which is the credit side. Now this cash account is drawn for the month of April. As you can see the dates in the first column, that it is mentioned 1st April 2019, and the first transaction which shows is that balance brought down or balance brought forward. Now what does this mean? If there is any surplus balance from the previous month, that is the month of March, that would have been brought down here, but since there was no surplus or there was no balance which was carried forward in the month of March, therefore in the month of April, when you started the new account for this month, the balance brought forward or the balance brought down is 0. Now understand this very well. On the left hand side there is two capital account. Debit side will be 2 and credit side will be buy. So debit side, there is a capital account where the capital has come in for 1 lakh rupees. There has been a sales for 95,000 rupees. So the total on the debit side is 1,95,000. But on the credit side, if we see, buy furniture is 15,000. Buy purchase, the company has purchased something, 75,000. Buy salaries, the company has paid salaries, 10,000. So only these three is there. Just keep these three in mind. Now if you total these three, 15,000, 75,000 and 10,000, it will come to 1 lakh. So the left hand side, debit side, it is 1,95,000. but the credit side is only 1 lakh. So there is a surplus of 95,000 if you minus that. So that is the balance which is carried down for the month. That means to balance the account, what they have done is they have written by balance carried down 95,000. So it totals up both the sides to be the same, 1,95,000, 1,95,000. Now this particular balance carried down on the 30th of April 2019, which is the last date of the month, on the 1st May, the first day of the next month, this balance will be written on the debit side as to balance brought forward or to balance brought down 95,000, and the cash account ledger will start with this transaction, which I explained to you earlier. Now this is an example of a profit and loss account. When I come to that in chapter number 21, I will explain that to you in detail, but I have just given you an example just for to brush through it, just to put your eyes through it. What happens in the left hand side? What kind of entries are there in the debit side? What kind of entries are there in credit side? Maybe you will understand some, you may not understand some. That doesn't make a difference right now. Just go through it. Because I am just giving you an example because we are discussing the objective of accountancy. That is why one objective is to prepare profit and loss account, and a profit and loss account looks like this. And after profit and loss account, you will find balance sheet. So the objective of the accounting is to prepare profit and loss, balance sheet, and these are the examples of it. We will move forward with this and I'll explain it to you when we come to chapter number 21. Now the next objective is depiction of financial position. A balance sheet, which is the final totaling of accounts, the final sheet preparation, will show there are two sides to balance sheet. If you get to see in the previous slide, you will see there the left side is the liability side and the right side is the asset side. Now it will depict how much assets does the company really have at the end of the year. What is the valuation of the assets? Similarly, how much capital the company has started with, how much capital has been used, and how much capital is still there remaining at the end of the year. There may be zero capital, or there may be 50% capital, depending on how much usage of capital has been made. And there is a liabilities also, because while doing business you have given credit to people, you have paid salaries, you have paid electricity, you have paid for water, you have paid for huge. So these are liabilities. So there is what final position your company is at the end of the year. When you are closing the books, it will show the correct result. This is the depiction. The next one is showcasing financial information. Now what is that? When we prepare accounts, there are figures at the end of the year to prove that where we are, the financial position where we are. Why do we need to prepare this? Because we have to show it to our owners, our directors, the owners of the company. Not only that, there are investors. For example, when I started the company, I have started with 5 lakhs, but the company required 10 lakhs to start. So where would I get the other 5 lakh rupees from? I borrowed it from a bank. When I borrowed it from a bank, the bank became an investor into my company. Now I have to pay back the bank with the interest. So I have to show my final accounts at the end of every year to the bank, showing them that where am I? Am I making profit? The bank will see that and find out, yes, this company is making profit. So he can pay the loan back. Then there are venture capitalists, there are private lenders which we have taken money from. We have to show it to them. Tax authorities, very important. We just can't go to Government of India and pay any amount of tax as we will wish. We can't do that. We have to submit our balance sheet. And in submission of balance sheet, it will be proven that this much of profit I have made. According to that, a percentage is fixed by the Government of India tax authorities, that much of tax is liable. I am liable to pay that much of tax to the Government of India. So I have to give my balance sheet. I have to give my final accounts to tax authorities also. There are shareholders in the company. If the company has gone public, then there has been shares floated. The shareholders have bought my shares, presuming that my company will do well and the share prices will grow and they will make money out of it. So I have to share my financial details with my shareholders also. And not only that, at times we have to share with our employees also, with our customers also, and with our creditors also. This is another example of balance sheet which I have given you, which is prepared for Paul's Guitar Shop Incorporation. The balance sheet is prepared on 31st of December 2015. Some companies close their accounts on December 31st. Some companies close their accounts final books on 31st of March. That depends on company to company. On the left hand side you will see assets, and the right hand side you will see liabilities. So there is, just to go through it once, in the current assets, which is the asset side, you have found that there is a cash of 32,800 still there. We are to receive 300 rupees. Prepaid rent is 1,000 rupees. Inventory, we've got stock in hand for 39,800. At the same time, on the liability side, we have paid 49,000 rupees. We have accrued expenses for various causes, maybe because of buying furniture, maybe because of paying rent, maybe because of repair of machinery, anything. We have incurred expenses of 450 rupees, and there is unearned revenue of 1,000 rupees. So total is 73,000 rupees here, and total is 1,49,950 here. Just go through it now. We'll explain long-term assets and owner's equity and all that when we come to it. I just wanted to explain this much to you, that what is really there on the asset side at the end of 31st December and what we have really spent by the end of 31st. Moving on with the advantages of accounting. Now first is replacement of memory. This we have done at the very beginning, that a human mind is not capable to remember or to recollect what all transactions we have put into journal or put into ledger. So therefore, we have drawn a systematic and in an orderly fashion, and we have recorded the transaction with proper dates, proper narration, proper amount, so that we can refer to it at any point of time. Not only refer to it, but also we can pick up the account from there for further calculation in trading, in profit and loss, and in balance sheet. The second one is that settlement of tax liability, which I just explained to you, that we are liable to pay tax to Government of India if we run a business here. Therefore, a preparation of accounts will derive that how much tax we are supposed to pay at the end of the year. So this is very important. We cannot ignore tax. This is an important part. This is a mandate. This is mandatory. The third thing is legal evidence. For example, there are people who have, suppose example, I'll give you that I run a biscuit company and I have sold my biscuits to 10 distributors and 5 distributors are not paying me. So I put it in the books. For a legal case, I have to show the accounts that these are the people, when I draw my final balance sheet, that this is what is owed to me. Similarly, the next one is sale of business. If I am selling the entire business, I can't just tell the buyer that my company is doing very well, it is doing very highly profit for the last 5 years. No one will believe that. His chartered accountant will never allow him to buy this company unless and until he sees the accounts, the books. When he sees the books year on year, when he sees the balance sheet year on year, he will see exactly what assets this company has, what liabilities this company has, what profit is the company making year on year. According to that, he will set a price. The third thing is realization of debts. The fourth thing is raising loans. Now, raising loans, for example, I am operating my biscuit company only in West Bengal. For example, I have got 100 distributors and I am sending biscuits to West Bengal and I am doing very well and I am running a profitable business. Now I want to expand into Bihar. So what do? I need money. I need sales people in Bihar. I need office in Bihar. I need distributors points in Bihar. I need godowns in Bihar. I need capital. Now I don't have that kind of money. So I will take my balance sheet and show it to a bank or show it to an investor and tell them that, see, I am doing so well. Here's the proof of balance sheet. I need more money to expand my business and to make more profits. And that's how you raise a loan. The second thing is the comparative study and assistant to management. These go hand in hand. Suppose I have done a business for 5 years and I can compare year to year. For example, 2020, this year, businesses have suffered because of pandemic. Now what has happened is that if I compare it 2018, I will see I have been profitable. But what was the reason? Because of pandemic, so there has been a comparative study. Not only that, department wise you can do comparative studies. For example, sales. If you take the sales department, for example, we can see, compare between two states, that we were doing very well in Bihar last year, but this year we are not doing very well in Bihar, we are doing very well in West Bengal. Why? We can find out the reasons. Maybe we have spent extra money in certain areas. We need to cut cost. Maybe we have paid salaries much more than West Bengal. That is why we need to increase our sales. We need to increase our distributors. So a comparative study and assistance to the management goes hand in hand, and we can derive results from it for betterment. Limitations of accounting. Accounting has various limitations. Its hands are tied in certain places. Number one, I'll just go through it. I know it is not in your syllabus, but it will help you in doing your accountancy if you understand this theory well. First of all, it is not fully exact. That means what? I have bought a machinery for 50 lakhs of rupees this year and I started the business for my biscuit factory. After 2 years, will the price of the machinery remain at 50 lakhs? Definitely not, because it has become little old. There has been a wear and tear in the machinery. There has been too many repairs in the machinery. So the valuation will go down. But by what percentage or what money? We are not fully sure. We just assume a figure and we put it. That is why we say that it is not fully exact. Number two, it does not reflect true worth. That means what? I have put stock in hand or inventory in hand in balance sheet that I have got 2 lakhs of rupees stock in hand or inventory in hand. Now I manufacture biscuits. So there is 1 lakh worth of biscuits lying in my godown. Now some biscuits are lying for 6 months and some biscuits are lying for 1 year. They have been expired. But I have not calculated that, because expired thing I cannot give it to the distributors. I cannot distribute it in the market. Ultimately I have to throw it. But at that time I will calculate the price of per packet into number of packets lying in my godown, and I will put it as stock in hand or inventory in hand. So it does not give you a true worth. So the third thing is the same thing, because it gives an incomplete picture. It is therefore inaccurate because the right valuation or the right stock price you have not got, so it's inaccurate. And ignoring changing value of money. There is always an inflation factor which is working. For those you do not know, inflation is the rising of the purchasing power. That means what? 10 years back I used to buy Cadbury big chocolate For 100 rupees I used to get 5. Today, after 10 years, I only get 1. That means what? There has been an inflation taking place. The purchasing power has gone up. The value of cash, the value of money has fallen down. So inflation, and just the opposite is the deflation. So inflation and deflation is a big factor in accountancy. Some people take it into consideration in the books of account, some people don't. Classification of accounts. There are 3: personal accounts, real accounts and nominal accounts. Please understand this, that personal accounts are those accounts which are just related to persons or organization. For example, Megha's account, Shreya's account, Binisha's account, these are all personal account. If you open a company, the name of the company is a personal account. The real accounts relate to only 2 things: tangible and intangible assets. Now what is tangible assets? Anything in physical form which we can feel and touch is tangible. Which we cannot feel and touch, which is not in physical form, are intangible. For example, cash, we can touch, we can feel, it is tangible. Land and building, we can touch, we can feel, it is tangible. Machinery, tangible. Which are intangible assets. For example, goodwill. We can't see, we can't feel, but there is a very big factor of goodwill working. When a company is sold, a huge amount of price is paid for goodwill. Therefore, this is divided into 2 real accounts. And the last one is nominal accounts, which is only related to expenses and losses or incomes and profits and gains.